Hey, welcome to this episode of Note Night in America. And I hope you all are rocking and rolling. It's the first of the year. And I wanted to start off January with some great resources for some of you. What we'll talk about tonight is not for everybody, but for those of you out there who've seen a tremendous amount of growth, appreciation in your properties, and you're maybe looking for some alternative ways to tap into some assets to help you go invest in some deals or buy some of these distressed deals that we're seeing at the huge returns. This might just be the Note Night in America episode you've been looking for. Our special guest tonight is not only a seasoned investor, but somebody who's done everything from teaching inner school youth about finances to helping Americans tap into the equity in their houses to make more things happen. Who am I talking about? Well, this guy, he's the head of sales over there at First Savings Bank, or also First HELOC as well out there. And he's our buddy Anthony Rushing joining us here. What is going on, Anthony? How you doing today, bud? Or
I'm
tonight, I
great,
should say.
dude. No, I appreciate it. Thanks for having me on, and give me the chance to sort of share a little bit about this, and I'm really excited to chat, and hopefully there's some people out there that can get some value from it.
Yeah, definitely. I mean, we connected base at FinCom
Mm-hmm.
in New Orleans last year, and then touch base beforehand and afterwards and stuff like that. And it was a great event, and I think that's an event that keeps giving year round for what it seems like.
It was awesome. I mean, I can't say enough about the event and the way it was put together, even from just the logistics and the space that they created to the different events and type events that they had, as well as the quality of people that were there too. In terms of the people that were there, from my experience, I saw people that were brand new, people that were seasoned, vets. I saw some pretty heavy hitters, but everyone there was modest and humble and out there to provide value and help other people and learn from others, which was just great. So yeah, man,
Exactly.
I met you through that as well, so I can't complain there either. So
Right, exactly. Well, it's a good thing that you said that too, because when we were talking on the phone back and forth and talk about bringing you on here, I think that was one of the great things about you and your personality, as we were talking about, and what we'll share with everybody here tonight is that um, it's everybody has different stories and different angles and
yep,
different things that they're trying to accomplish. And what we'll talk about tonight is not for everybody. It
right.
could be the worst thing for everybody. For
It
those,
could
so
be.
it could be a
Yep,
bad thing if you don't use it right. As
right.
an ex-financial advisor and ex-mortgage banker too, there was always times where like, hey, people came to me like, hey, I want to do this. I was like, this is not a good fit for you. But
Mm-hmm.
for others, it can be a very good fit for you folks. So let's talk a little bit. Let's dive into kind of what we're sharing. I think you got a PowerPoint
I do. Yeah.
too that we can share in and dive and talk about folks out there. And then I think we talk about what this is we're going to talk about tonight, and then who's a fit for and who's a not fit for, and then dive into some more questions from there.
Love it. That sounds great. Sounds great. So all in all, I specialize in teaching people about a mortgage product. It's different than the amortized mortgage. It's called the first lien HELOC, and so it's just a different mortgage product that follows different rules, we'll call it, than an amortized mortgage does. And so what we do is we specialize in teaching people how to work within the rules of this loan, right? How to fully maximize what this loan is capable of, right? And for some people, when it works, just like any sort of product, right? Any sort of product that you're looking to buy on the market, certain products are going to align with your goals and your situation in life and what you want, right? So like, I've got kids. I'm not going to go buy a motorcycle right now. And like, and not to make it too, I want to buy a motorcycle, but I'm not going to. Right? Right. And so just like any other product, no product is necessarily going to be a one size fits all best for every single person every single time. So what we're trying to do is just really advocate for this and educate people on here's what it is, here's how it works, here's who it works for, right? To the point where it becomes just another option that people choose when it makes the most sense for them. And if it doesn't make the most sense, obviously you choose the option that's better, right? And so it's a relatively unknown concept here in the States. It's super popular in countries like Australia and South Africa. It's their main mortgage product. Throughout Europe, it's another type of home loan that people choose when it makes the most sense. So it's not new. It's not even new here in the States. It's actually been around since before the amortized mortgage was created. So, but all in all, it's just relatively unknown. So what we want to do is take the initiative to share what it is and how it works, who it works for. And when it works better for some people, we can help you get into one as well.
Well, that's the thing is when we were talking about, we get folks that reach out to us all the time that want to get into investing. They may
Yep.
not have a lot of money available to us. They may have a 401k retirement account stuff set up, but they don't necessarily have a lot of money set aside to dive into it. And oftentimes, like, well, hey, if you've got some equity in your house, we've seen an increase appreciation like we have the last 5, 6, 10 years, depending on what state you're in. That might be something to look at if you're able to tap into it and then not missing out on opportunities that are definitely presenting themselves in the market. So you want to bring up your
absolutely.
slides.
So
I think we can kind of start there.
People ask me, who benefits from this, right? What's your main target market, we'll call it, right? And so, when you're in this type of business, you talk about target markets. What that means is basically what type of person benefits from this, who, in terms of people that want to achieve a certain goal, who benefits from this, which basically is like, who do we want to talk to, right? And then who, in terms of this being a value prop to them, would it be worth your time to really dig into it and learn about it, right? Not that it's not worth it for everyone, because I believe in education for all. Right. But in terms of it actually benefiting your life, you want to kind of know, is this something that's going to work for me? There are two sort of main goals that people can achieve with this, so they're kind of like two different target markets, which is unique in its own way. Our sort of tagline, we'll call it, is pay off your home in 5 to 7 years, right? So this particular financial vehicle, we'll call it, can be used in a way that allows for you to aggressively pay off your mortgage balance really quickly when it works for you. Right now, I'll always come back with that. When it works, that's true, because again, it just follows different rules. So you can treat it differently than you can an amortized mortgage, right? And that's basically what we teach. So for the right person, they can aggressively pay off their home and become debt-free. The other reality of this is that when you pay down your balance, this loan allows for you to have access to a certain amount of equity in your home. So the more that you pay it down, the more access that you have in the equity in your home. Well, that amount could be $10,000, and that's great, right? 10 grand, that's a nice cushion, right? That amount could be 50 grand. It's a pretty decent cushion. If we're talking about 6 months of income, that's sort of our staple. Some people teach that's the rule, right? Yep. And so if we're going to follow that fundamental, assumption that you want to have, that 50 grand can serve as that purpose and let you have peace of mind. Let's say you've got $100,000 to $300,000 that you can access immediately with your equity. Now, an amortized mortgage, and I'll go into this with the PowerPoint too. So it'll be more formalized if that's fair, but the amortized mortgage is called a closed-ended loan. So every dollar you put toward paying down the balance, it's locked away and you can't pull it back out. That's just how it works, right? It's just part of the rules.
Right.
A HELOC, home equity line of credit, is different. It's called an open-ended loan. So what that means is money can go in and money can come out freely. So every dollar you put into it, you can take out, right? Well, let's say you have $300,000 in equity in your home that you can access, right? Suppose you're not investment minded. What that allows for you to do is ask the question, what if I were to take $100,000 out? Not that you should, right? What if I took 100 grand out and invested at 15% over here? What would happen, right? Most people, pretty much all people I know, I don't run with a super rich crowd, but like most people I know don't have the ability to even ask that question, right? Because they don't have access to $300,000 that they could use at their disposal, right? Now, if you're a naturally born investor, you'll find ways to do that, right? But for people who aren't, they can't even ask the question, so it doesn't even allow for them to think about going that direction, right? So this at least gives them the ability to ask that question. That's sort of the beginning of I think of it like, first we're in a extreme debt reduction. Let's pay off our house and live the traditional American dream, which is amazing, by the way, right? Mm-hmm. And then now they're sitting on $400,000 and they're like, well, wait a minute, could I use this? And that starts this progression from debt payoff target market, we'll call it, right, to investor target market, right? And so that could be something that there's a progression that happens. This just allows for people to access more capital, we'll call it, than they would have otherwise without it. So it can, in that respect, if you're smart and if you're wise with the investments that you make, then it can be a very powerful tool from an investment standpoint as well.
Right, exactly. I keep thinking about, those Dave Ramseyans out there talking about how he's all debt's bad. You pay off your mortgage. I'm like, that's great, but I think honestly, that's great. You have paid off your house. Well, then if something happens, the only way to access that would be to actually sell your house in a lot of cases.
Right.
And people don't necessarily want to do that.
Right.
This works as a way so that hey, if you do want to pay it down, you can, but then you still have that option to tap into it in case of sickness or job loss or an opportunity in cases.
Absolutely. And I think it's interesting and great that you bring up Dave Ramsey. He makes this assumption, and we'll get into this more. He makes the assumption that when you get a HELOC, a line of credit, that automatically you will become very undisciplined and you will run up your balance. Forget a $14,000 credit card. You run up your balance on a $500,000 line of credit, right? So you are. The fallacy in that is that for people that have trouble being disciplined with their finances, right? For people that are living month to month, right? For people that are in a season of life where their expenses match or exceed their income, right? Dave Ramsey is completely correct, right? I'll give him that, right? But let's say that there are people out there that are really disciplined with their finance. Let's just say that, right? Apparently that's what his
and he's getting grouchier in his old age. He is literally getting grouchier in his old age.
That's
my opinion.
Well, here's the thing. I don't want to go toe to toe with the man because he's much better at insulting people than I am. So I don't want to go there. But in terms of the logic of that argument, for people that are disciplined with their finances, the assumption he makes is just by getting a line of credit, all of a sudden you become undisciplined. Right. That's not true. Right. That's not true. And so what this is this is a tool that that highlights or that gives credit to people or helps people who are disciplined with their finances.
Right.
And either want to pay off their house really quickly, which is awesome, right? Or that want to build as well, right? And so it's sort of, to me, it's like post Ramsey, right? Once you don't need him anymore, this is a great next step to consider, right? Exactly. Once you can live below your means, make more than you spend, you're disciplined with your finances, and you can be consistent with that. I am confident that the majority of the time, with that particular person, this loan product will outperform a low rate mortgage, even with a high rate HELOC. And so,
totally.
So we can kind of get into that too, but yeah, I mean that's kind of what this is, and so it's exciting to me because I still get to, like you said before, I was a teacher, and I loved that, and I hope I was good. I built a skill set in terms of being able to present content in a way that people can access, right? I did, I did real estate investment. I was with a group. We ended up having 40 doors, right? I played music for a while, which was pretty awesome too. And then I also, do the loan stuff as well, right? The mortgage, and so there are different skill sets that I've had the luxury of being able to hopefully try and build up, that I think all kind of come here, and they all my passion for helping people. I get to teach people about something that, when it works, truly changes the trajectory of their life, and we all feel like that here at the branch. And that is, to me, it's like the gratification of knowing that my work results in improving people's lives. That's huge. And the cool thing is, when the numbers don't work, we all agree. We tell you, if you don't see it, which it's usually pretty obvious, right? But if you don't see it and the numbers don't work, we tell you, hey, this doesn't look like a good idea, and you move on. So that the numbers prove whether it's right or wrong. We don't have to sell anything. I stink at sales. So like, I don't have to sell anything, right? It's just like,
The
hey, look,
numbers don't lie.
numbers don't lie, right? And you know, if the premise that we're putting into the calculator that we use, if those are true to your scenario, then you can expect for the outcome to happen. So it's really pretty cool.
Good stuff. Well, let's dive into some of those numbers or dive into some of those things and walk folks through it a little bit.
Love it, love it. So this is a PowerPoint that a presentation I put together. It starts from the basic fundamental of what this is and what it's not, kind of what we're here to do, and then it'll get more detailed as we go. There's some questions that people usually ask that I can address as well. So yeah, we can just get started with that if that works for you. So
yeah, definitely. I think it'll get folks will get Nancy here. Or what are they talking about? How can I use this? I got all this equity. I live in California, or I live in Texas, or Florida, or other places like that.
Stop wasting time, guys. Stop wasting time. Get to it. All right. So I think this is the one.
Perfect.
Yep. Do you see it?
Yes, sir.
Okay, cool. Awesome. So we're going to teach about first lien HELOCs today. Again, we have the product. I work with First Savings Bank. I was here when my boss built it. I don't say that I helped build it because I was just here and I watched and I helped him do things, but he built it. But we specialize in teaching how to use it, because all in all, it's just a financial vehicle. If you don't use it in a way that leverages how it works, then it's a nothing, right? So our approach is to lead with the education so people know how to use it. And so, let's see. Got it. So purpose today is to learn about a mortgage product that is helping a lot of people across the US and the world as well, to understand how it works and who it works for. And generally speaking, want to give anyone who's watching this a good idea as to whether or not this would be a good fit for you, a likely good fit or not, right? And so really that's the whole purpose. So what is a first lien HELOC? It's a home loan, and it just works differently than a mortgage does. That's it. It's an option that's available. It's available throughout the world, and it's really popular throughout the world. So I know I mentioned this before. Australia, main type of home loan that they do. South Africa, main type of home loan that they do. Across Europe, it's considered another option, right? I talked with someone a week and a half ago who they work with a very diverse clientele, and they said, you know, the clients that I get from Asia and from India, Asia and Australia, sorry, they all know about this. This isn't a new thing to them, right? And so one thing is here in the States, it's just not well known, and we can kind of go into, you know, my thoughts of why that would be, you know?
Well, I can tell you why it's not well known here, especially in Texas, because people that wrote a lot of the lending laws were realtors back in the day, and they didn't want people tapping their equity unless they had to hire them to go for it. True story here in Texas. So
I didn't know that.
Wow. Oh yeah, totally. And that's why we can keep moving on, but that's part of the issue.
Huh. Yeah. What do you know? That's wild. And then I've got this amazing, very detailed timeline here of now and then when the first lien HELOC was available. And in 1913, the amortized mortgage, which is the home financing option that everyone thinks is the be all end all, it's the only option right now. That's when the amortized mortgage as we know it was created. Before that, farmers had open-ended lines of credit where they could access the equity. Yeah. And they could put it back in. So they'd pull out to buy seed, buy their equipment, fix their equipment, and buy livestock, and then they'd have the season and they'd harvest, and then they would sell and profit, and they would put that money back into this home equity line of credit, which would pay down their home loan. That's what we teach. That's something that people think is not real, but it's actually been around longer than what we think is the only option. So what I do is I basically teach people how to leverage this product to help them reach their goals, right? I teach them how to fully leverage the way that this works to maximize its benefit. And again, sometimes that works a whole lot better for people than what they have right now. And so that's kind of what we're doing. So what are people doing with this, right? What are the outcomes people are achieving with this? Well, they're paying off their homes really fast, for one. So there's a debt reduction piece. pay off your home in 5 to 7 years, that number is true to our actual portfolio. So this isn't a theory that we just created based on conversations that we have before people get their loans. This is like our portfolio of over $400 million worth of home loans. That's what that's tracking to. So this is backed by data. People are saving tons of money on interest costs. People are using their equity to invest in other assets that are cash flow producing assets. They're creating emergency funds for their families that aren't available to this degree otherwise. And they're simplifying their life. They're simplifying their financial life. And we can kind of go into why that's true. So these are all outcomes that people are achieving with this when it works for them. So first thing is that, when we hear HELOC, we think of something, right? When people hear the word HELOC, they think of, I've got my mortgage and I get this HELOC on top of my mortgage, and I can take money out and buy a boat, or I can pay for my kids' college, or consolidate other debt here, right? So in this structure, you have a first position mortgage, a first lien mortgage. And basically all that means is they get paid first if you default.
Right.
But in terms of how people picture it, at least how I picture it in my mind, this is how I see it, right? So I've got my first mortgage, I've got my HELOC on top, and I can borrow from the HELOC, right? So that's the way people usually think of the word HELOC. This is not that. This is different than that, right? So a first lien HELOC comes in and pays off your mortgage. So you don't have a mortgage. So if you notice with this sort of diagram, right? I've got the green portion, right? And then I've got the white portion. The green and the white is the total amount that you'd have access to, right? That's your line. It's comparable, and I don't like to compare this too much, but it's comparable to the limit that you have on a credit card. It's the maximum line amount that you could access. Well, the green portion of this is the amount of the mortgage from before, right? So it pays off your mortgage, takes on that balance, right? But then in this scenario, the line amount is higher than where that balance is. So that is the portion of the equity that's available to you right away once you close on your first lien HELOC, right? So that's how this is different. It's one big HELOC, not two separate loans.
Right.
So that's how it's different than a second lien HELOC. So how are people paying off their homes really fast, right? It's a strategy called the maximized cash flow strategy. Some people call it velocity banking. Maximized cash flow strategy is our little thumbprint, if that makes sense. But velocity banking is the term, or the one that is most common, most used. We're working toward getting maximized cash flow strategy at that point. But anyway, basically the maximized cash flow strategy is, we know how this works. How do you leverage the way that it works? So in order to understand how to do that, we have to understand what's different, right? Well, one has to do with money flow, and the other one has to do with how it calculates its interest payment. So money flow, I brought this up earlier. Your amortized mortgage is called a closed-ended loan. So once your money goes in there, it's locked away, right? You can't take it back out. You can pay it down, pay it down, pay it down, but it's locked away. It's stuck in there. You can't take it back out. First lien HELOC is called an open-ended loan, which what that means is money can go in, which pays down the balance, but you can also pull the money back out. Obviously, when you pull the money back out, it increases your balance, right? So that's one fundamental difference between this and an amortized mortgage, which allows for you to treat it differently, right? What that means is you can safely put as little, you can put as much, you can safely put everything that you have right now toward the balance of your home and dedicate that toward paying down your home safely, because you know you can take it back out if you need it, right? That's a fundamental difference. The second has to do with interest calculation. So your amortized mortgage uses a monthly interest calculation. So what it does is it looks at your previous month's end balance, and the balance on that day of the month, and it pins that against your rate to calculate your interest payment. That's just what it does. It uses the previous month's end balance. First lien HELOC does not use, or the right first lien HELOC doesn't use a monthly calculation. It uses a daily calculation. So what this does is it takes what's called the average daily principal balance, and it uses that average daily balance against your rate to calculate your payment, right? Well, let's think about that. if our average balance is higher, our payment is higher, right? If the average balance is lower, the payment's lower. Now, I know this is rudimentary, but at the same time, this is a concept that is extremely important to understand, right? So if you want to pay more, create a higher average. If you want to pay less, create a lower average. If you want to pay the least amount possible in your power, create the lowest absolute average balance possible, right? Well, how do we do that? I've got, I think, either 30 or 31. I forget how many little sticks I've got, but each one of these represents a day of the month, right? And the balance in the day of the month. Right now, the line in between is the average of all those days, right? So if I want to create the lowest average, I got a bunch of days here, right? I need to create the lowest average for the most number of those days. Oh, sorry, I need to create the lowest balance for the most number of days, excuse me. And if I create the lowest balance possible for the most number of days, that results in the lowest average balance, right? So that's kind of the key here, right? We need to create.
So a good example would be looking if you had a $100,000 mortgage over 30 years, you'd have the same P&I payment the entire 30 years, no matter what. Whereas as on your credit, on a first lien HELOC, that number is going to go down as it's paid down and fluctuate down.
That's right, because with an amortized mortgage, you make a payment, and some of that payment goes to interest, and then escrows and stuff. And then whatever's left over goes to principal. So when we say how much of my payment is going toward principal, that you can say that because when you have a payment, part of it goes to interest and others, and then whatever's left over goes to principal. The principal reduction part and the interest payment here happen at different times.
Yep.
The principal pay down piece happens, which we'll get to next, when you drive in all your income, right? The payment that's made to the bank is strictly the interest that's due for the previous period, right? So that's a great point. So as the balance goes down here, the interest payment goes down as well because your balance is lower and the payment is based off of the average balance. So as the average balance goes down over time, the payment goes down. So then the question is, how do I create the most days with the lowest balance? Well, it starts on that first day. That first day possible, you have to create the lowest balance possible, right? Well, then how do we do that? Well, when you get money, all the money you get has to go into the HELOC. And again, I know I'm presenting this in a financially high level, understanding, but I think using language that is, for what it's worth, I do that on purpose because using language that is common allows for people to connect with the concepts easier, right? So I'm not trying to patronize anyone here. I just think in order to connect with new concepts, it's good to use basic language, and we can get to the technical stuff a little bit. So here we have to create the lowest balance possible as fast as we can, right? So when I get money, I put it in the HELOC, put it all in the HELOC. So what that means is that actually leads into the first part of the strategy, which is when you get paid, you deposit everything that you have into your HELOC, not your checking account. It all goes there, right? So when you do that, if you look at the diagram below, right, it decreases your balance as much as possible. You're controlling your balance as much as you possibly can. So what we're doing is with everything you have, you're controlling the amount of interest you pay for that day, and you're creating the lowest amount possible, right? Well, your mortgage company would allow for you, your amortized mortgage company would allow for you to put everything into it. Now, it'd be hard. They don't like it when you do that, but they would allow for you to do it. So you can still do this with an amortized mortgage. The only thing is now you got to eat food, right? And you have to pay for some bills, and now all your money's locked away. Well, remember, this is an open-ended loan. So everything you put in here, you can take out. Well, guess what? You need to pay for groceries. You do just that. The second part of the strategy is you use your first lien HELOC, you pull from it to pay for all your bills during the month. Well, here's what happens. Look at the diagram, right? Decrease our balance as much as possible. We pull from our HELOC, which increases our balance throughout the month as we spend money with it, right? So at the end of the month, We've decreased our balance with everything possible. We've paid our bills. Now it's the end of the month. Well, all of the income that you put in there that you didn't take out for what you need is simply still in there. Because remember, everything goes in there first. I was talking about the principal pay down piece, right? You do the maximum principal payment possible at the beginning of the month because everything you have goes toward it. That's what pays down principal, but then you take away from what you put in there, right? So whatever you have left over is what pays off your house. I can spin that another way, right? That's more to the benefit of this ideology or this idea is that means every single dollar of surplus that you have in real time is dedicated toward paying down your house and saving you money on interest, which essentially means with the same exact cash flow, there's no faster way to pay off your house because everything is dedicated toward paying it off, right? Now, that is a way that I can spin that to make it sound really awesome and cool, right? But it's true, right? And so that's all this is. All your money goes in, you take money that goes out. So let's think about a family A. So I'm going to sort of show two different examples here. One where this is one where it works, one where it doesn't. Because again, one thing I want to help people do is put themselves in this is a good fit for me, this is a not good fit for me, not because I tell you it works or it doesn't, but because you truly understand the concept of what this is. And so, because I want people to know what this is. And so we're gonna make some assumptions. And these assumptions that we're making are similar to what we see on a daily basis, if that makes sense. So principal balance, they owe $300,000 in their house. Their income is $10,000 a month, and their expenses are $7,000. Okay, so this is a household that makes more than they spend. If this is consistent, they're diligent with their finances, right? This type of budget, it's the budget decision that determines whether this is a good idea. So if you're watching this and you're curious, how do I know? The budget piece is the alignment. That's really, it's not any more complicated than that, if that makes sense. So
Yep.
10,000 a month in, 7,000 out. So here's what happens, right? They start at 300,000 and 10,000 goes in, right? All their income, which brings their balance to 290. That very day, they're paying interest on $290,000, right? And they've reduced their balance as much as possible, creating the lowest balance to pay interest on at that point in time. Then what they do is they pull from their HELOC to pay their bills throughout the month, and that increases their balance by $7,000 to bring it to 297. Well, that's the end of the month. Well, out of the 7,000 out of the 10,000 they put in, they took 7 out. They still have $3,000 in their HELOC. That's their principal pay down for that month. Well, next month comes around, they get paid again. 297 goes down to 287. Pull from their HELOC, $7,000. They're consistent with their budget, right?
Mm-hmm.
They now have $6,000 in equity in their home, but they've paid it down because that's the amount of surplus that they've had from their budget each month. Again, it comes down to your budget decisions. That's it. It's like, it's really not any
very simple as that. I mean, that's the thing is you don't live among your means. If you're spending $15,000 a month in expenses versus your $7,000, that's not the way you want to be.
That's the opposite side of things.
Yeah.
Right. And I'll get to an example like that in just a bit. So with these results, right? $300,000 balance. I'm using a 7.75% interest rate for the HELOC.
Okay.
10,000 in, 7,000 out. That's a 7-year, 1-month payoff time. Total interest costs of $90,148. So this next metric, we'll call it, is what I found people do is naturally we use the interest rate to determine whether a loan is good or bad, right? Well, here I am, hey, I got this awesome home loan and it's 7.75%, right? And these days that's not that bad. I mean,
right.
Well, but our variable rate products at 8.5%, right? Just probably a year ago. There's no way anyone would consider or touch a home loan in the 7s And that really freaked them out, right? So even people that kind of got over that initial challenge, right? We'd run their numbers and they'd say, oh, well, the rate's so high. And I would respond with, yeah, but this $300,000 home loan is going to cost you $90,000, right? I'm like, I'm excited. And they're like, no, I don't like it. It's the rate's too high. And then I come back and say, well, but it's going to cost you $90,000, right? And then we do this little round around sort of dance. And I failed people because I see a $90,000 cost, and I know that that's amazing for a $300,000 home loan, right? Mm-hmm. They see 7.75, and I've learned that there isn't one person I've talked to, and maybe I just haven't talked to the right people, but not one person who truly connects with the overall cost of their home loan, right? It's on your closing disclosure, it's on your initial disclosures of your amortized mortgage, it's in big print, so that way they can say, hey, we disclosed the full cost of this loan. But no one uses that because it's arbitrary. Like, no one's going around like, hey, my home loan's going to cost me $230,000. Like, it's like, no, I've got a 3% rate, right?
Right.
So what I wanted to do is create that connection so people could see what they're actually getting. So what we did is we took, in this scenario, a $300,000 balance against the $90,148 total interest cost to calculate to back into the interest rate that you'd need to have with a 30-year fixed rate mortgage for it to cost that much, right? So the rate on paper is 7.75. And I tell people that's the rate that you're going to grit your teeth and you won't tell your friends about because they'll make fun of you, right? But in this scenario, a $90,148 total cost is equivalent to a 1.83% interest rate on a 30-year fixed rate mortgage. So what I tell them is that's what you're getting, right? Mm-hmm. In terms of the outcome from a cost perspective, even though the interest rate's higher. And so that helped people really connect with that piece of it, which is like, if this is bad, we need to show you that it's bad. But if it's good, I want to be able to show you in a way that you're going to connect with this, that it's actually good, right? And so that 30-year equivalent rate is that. So I kind of want to explain that too.
So because basically you're saving as you're paying it down. You're paying it down 23 years faster.
Yep.
If you looked at the traditional cost of the mortgage, it'd be 2-3 times what your original mortgage is if you did it over 30 years.
That's right. Yeah. It comes down to two different factors. I think I've got a piece on that too, because there are common objections that people have, common questions, that kind of stuff. So let's talk about a different household scenario, right? This household still owes $300,000. They still bring in $10,000 a month. Now, this is going to be an easy one for us to do, but I wanted to display this too. They bring in their monthly spend is $10,000 on average also. So this would be someone who lives month to month, right? Bring in money, right? They're on a really tight budget. Whether it is from your financial decisions that you're making, whether it's from your season of life that you're in, whether it is because of income, lack of income, right? This is what will happen in this scenario with the first in HELOC, right? So start at 300,000, we know 10,000 goes in, down to 290, but our lifestyle requires 10,000 income, so 10,000 in expenses. So we pull out 10 grand, which brings it back to 300,000, right? Next month, 10 grand goes in, right? Back to 300,000, right? 290, 300, 290. This household would never pay off they would never pay off their house with this strategy. This is a terrible idea for this household. Hear that, Mr. Dave Ramsey? This is a bad idea for that household, right? And it is.
It totally is.
Pretend like it's not. I mean, it's a bad idea. And then couple it with maybe someone who doesn't have the ability to budget or be disciplined with their finances. Now you've got, let's say you get that home and you've got $150,000 of equity, right? Well, your example before, say 10 goes in and then you overspend 1 month by $5,000, and now your balance goes from 290 up to 305. So at the end of that month, your balance has increased, right? Well, next month, 10 grand goes in. Let's say you don't catch it and you do the same thing, right? Now you're up to 310. it can go the opposite direction. And that's the danger with this. That's the thing that people talk about. That's when you hear people who have heard about this idea and this strategy who dog it, they're correct in this scenario. They're right. Like I don't want my work to be work that gets people who are not good with their finances or who live on a shoestring budget, no, not shoestring, who live month to month, right? Or who have a very tight budget. I don't want to give those people this loan because it would be bad for them, right? I want people who are going to crush this to get it, because then it can completely change their life, right? And so I think it's important to say that, right? The reality is no one's going to, if you overspend 1 month, let's say in this scenario, you've got your 10,000 income, but let's say you spend 11,000, right? So then it goes up to 301 instead of the 300 that's shown here. No one's going to come slap your hand if you do that, right? Bank's not going to call and say, hey, you spent too much. Like that's not, like, people ask, do I have the freedom to invest with this, or real estate? And that's usually the question. And what I say is you have the freedom to make bad decisions with this too. And so that right there needs to be said, because if it doesn't, then I'm someone who's trying to push something and claim it's good for everyone. And the reality is that's not true.
Right.
But it is amazing for a certain subsection of people, right? So, so here's some initial understandings. Using the maximized cash flow strategy allows homeowners to safely leverage everything, right? Toward paying off their house. So essentially, because you can use everything to do that, there's no money anywhere else in the ideal strategy. So there's no faster way to pay down debt, right? It only works when the household makes more than they spend and when they're disciplined with their finances. If a household is tight on their budget, this will not perform an amortized mortgage, right? The amortized mortgage is going to be a better option. I can go all day dog an amortized mortgage. I can do that. But the reality is that there are a lot of scenarios where the amortized mortgage is a better option than this, right? When it does work, homeowners can pay off their home much faster than what's feasible or possible with an amortized mortgage. And they can save gobs and gobs and gobs of money. Gobs of money. I'm talking like tens to hundreds of thousands of dollars. And we see it on a day-to-day basis. I've got testimonials like crazy right now. And they're amazing to see, because it's sort of a follow-up on, with the theory that we have, does it actually happen? It does. Right. It really does. So common question, how can a higher rate beat a 3% mortgage, right? Well, there are actually three things that lead to your total cost. There's the rate, and there's time, and then there's balance, okay? Three things, not one, right? We don't talk about time or balance because time and balance for amortized mortgage are controlled by the amortization schedule.
Right.
And so because they're controlled and set by the amortization schedule, it's not worth analyzing their effect on the loan because they're set. So the only thing that you can choose is a higher or lower rate, right? Well, let's talk about time. So if you're at home or if you're watching this, right, I want you to look at both of these options and think about which one would you choose, right? Would you choose $100,000 home loan at 10% for 1 year, or would you choose a $100,000 loan at 2% for 30 years, right? Now, it's funny, when I ask people this question, they'll say, oh, I choose the 1 year rate. And I'm like, no. The 1 year product, right? Because they want to talk about time. It's like, no. Would you choose the high rate option or the low rate option? And then it's painful for them to say it, right? But they're like, I would choose the high rate option. I'm like, well, why? Right? And they say, well, because the time's so short. Like, yeah, exactly, right? This one costs you $10,000. This one costs you 60 grand. I would much rather pay $10,000. And again, these are very vacuum-ish examples, but I'm trying to get to the root of how it's possible that a high rate home loan can beat a low rate home loan, right? The other one has to do with your balance, right? Now, this one, I made this super, super extreme, right? Because when I get it closer, sometimes it's tough for people to do the math. So let's take a look at these two. Would you rather pay for 1 year, a 15% rate on $1,000 balance, right? Or 2% on a $100,000 balance, right? So now we're talking about differences, balances, right? Well, this is one where people will be like, oh, I'd rather the low rate. I'm like, are you sure about that, right? Because they want to say the low rate, right? We're trained, we are conditioned to think that the rate is going to, unless it's some whack example, right? That's so obvious, right? Which I try to do with this. Maybe I should do $1 million loan at 2%. But
well, but this comes as an example when you have a lot of real estate investors, so when they look at using hard money loans that are at 12 or 15% for hard money,
yes,
they're a short period of time. So when you start talking about, well, I've got a 15% mortgage on my investment, oh my God, it's horrible. No, it's a 1 year loan. So the cost isn't that much. I'm paying it off.
That's right. And so exactly. So this scenario, 15% rate would be $150 a year. 2% on a $100,000 higher balance is for $2,000 a year. So the challenge people have with how is it possible that a high rate can outperform a low rate home loan is that has to do with time and balance. Well, let's just say there's a home loan out there that lets you pay off your house really fast. And let's just say there's a home loan that when it works, you can cut your balance in half. You're paying on half the balance in like 3 years. Let's just say there's something out there, right? That scenario would be one where a high rate home loan would outperform a low rate home loan. Well, that's what a first in HELOC does, right? When it works. And so, that I've been really focused on the debt reduction piece. The reason why is that generally speaking, we believe that that has to work if you're going to leverage also, right? This can't just be a leverage tool where you just borrow a bunch of money and try and create cash flow for yourself so this works. That's unacceptable. There's a ton of risk that comes with that. And does that make sense, right? So the premise of this, regardless of whether you're just trying to pay off your house or whether you want to leverage like crazy, right? And just grow your portfolio to 500 doors, right? Or other investments as well, right? Regardless of which goal you have, this strategy needs to work because at its very least, this needs to be better than an amortized mortgage, right? So that's why I've been focused on the debt reduction piece so far, because that piece has to be a given before we talk about the leverage stuff, right?
Right.
So now we can go the leverage direction, right? There are so many ways, there's so many places to go, but it all starts with the idea of arbitration, right? Financial arbitration. You may be able to, I know what it is. You may be able to explain it better than I can though. Scott.
Well, it's basically taking the arbitration aspect of it is basically you are cutting yourself in the middle, pulling money in and cutting yourself and making a higher profit on it because you're in the middle aspect of it. Like what you do, if you're borrowing money at 8%, but you're making 14%, you're basically making a 4% profit based on numbers, but your actual ROI is infinite because you don't have any of your own money involved in the situation.
That's right. So exactly. So the idea of financial arbitration is basically you borrow money at a certain interest rate. And in order for arbitration to work, you have to make more interest on the investment than you do at what you're borrowing, and the net gain is the spread between the two, right? So, but the ROI piece is a great one to bring up too, because your ROI you're right, because it's not your money. You're borrowing, you're using someone else's money, and it feels personal because it's connected to your real estate,
right?
If we think about this strategy, all your money goes in here, you use it to pay your bills. So that covers the day-to-day expenses piece, right? Then let's say you've got 50 grand in savings somewhere else, right? Well, that is a safe place to store liquid funds. Well, the first in HELOC is also a safe place to store liquid funds. So then the question that's begged is, where's the smartest place to store your liquid funds, right? In a place, high yield, what, I don't know, 3% these days? Maybe these days, right? It's higher now these days than it has been.
Right.
But I used to
T-bills, I think T-bills are like 4% or something like that.
There you go.
Okay,
right?
Great.
So you make 4% or you offset at 7.75 your cost, right? Well, which one's better for a net a net benefit, right? Cutting costs by more or gaining at less, right? And both have sort of a compounding effect. So in terms of the effect long term as well, it's apples to apples. So I would rather save at 7.75 or 8.5% than gain at 4, right? So if we think about 50 grand in savings, the savings account with that methodology is not the best place to store liquid funds. It's in a HELOC, right? So
Right.
that decreases your cost, right? So, but then there's this whole idea of borrowing from the HELOC. We're talking 10, 20, 40, whatever you've got, right? So what it does for an investor is it just gives you another option along with the ones you already have, right? You know, if I think about time and access to funds and rate, right? How quickly can I get the money?
Yep.
And then what's the rate going to be, right? I can, we can get hard money. If we're talking about flip and a rehab, right? I can get hard money, what right now, 12?
7 to 14 days. Or you're talking about rates. How soon you could probably be 7 to 14, maybe 7 to 30 days, depending on the situation.
Right.
It's going to be at least 12% plus a couple points as well for you.
Right. Point of the front, point of the back kind of thing.
Right.
So, and
But there's going to be limitations on that though too. There's going to be limitations on how much versus the value of the property, maybe your experience, and even more and more hard money lenders are looking at what's your credit score, what's your experience on this, and what they lend on it. Yeah.
So, you know, we're talking something anywhere from 7, we'll just say an average of 14 days for hard money, and 12, 13, 14% total. If we're talking about if it's a quick turn. So in that scenario, the rate's okay, right? Timeline is okay, right? We've got a bank loan, construction loan, you know, 2 or 3K kind of thing, which is primary residence. So now you're talking about finding a lender that knows how to do those loans for one, which, you know, everyone will tell you they can do it, but they're tough.
Right. It's a smaller niche, definitely.
And you're right. And then, but the rate's good, right? But it takes you 30 days to get the money, right? And let's talk about immediacy. I can go to SoFi tomorrow and get $200,000. Well, maybe not that much, but for me, but you know, let's just say that, right? But that's at like 17% and it's at a 5-year AM, right? So now you're talking about a massive payment each month. I can get it right away, but the interest rate is extremely high and it has a high payment. First thing, HELOC is another option, right? Well, now we're talking about something you can access immediately, right? It's dependent on how much equity you have available in the home, right? So I can't say it's automatically $400,000, but it is dependent on how much equity you have in the home. So if you have a good amount, now you're talking about immediate access of X at 8.5%, 7.75%. So from a time standpoint and from a rate standpoint and an accessibility standpoint, if all those are factors in your decision, then this would be the place that you'd use to borrow against for a certain job, right? Now, if you don't need, if one of those factors doesn't matter, then it's more of a decision. But you know, and again, like I did multifamily, so I didn't have 40 single family homes, right? So like I didn't, like as you and a lot of your viewers probably do, I didn't take advantage of multiple streams of borrowing money, you know, subject to that kind of stuff, right? So I understand that there are multiple ways outside of what I just explained. So there may be others that kind of fit the bill too. But again, from an investor standpoint, this is one where the strategy, you're still doing velocity banking with it though, right? You pull, oh, sorry, go ahead.
I was just going to say, what's your normal turnaround time if once they're accepted and they have equity? What was the turnaround time? I missed it there, of being able to tap into, if you need to say pull 20 to 50K out for a rehab project. What's the turnaround time for that money's funded?
So
once it's approved, once you've gone through the approval process,
once it's approved and everything's set up,
right?
Day of,
right?
You wire the funds, or you do an ACH? I mean, that day, once the loan funds, there is a timeline where it takes to set up, because ours works in coordination with a checking account too, which we built it specifically for that strategy, right? And so that's another piece to this. But in terms of accessibility, once it's set up, this functions through a checking account. So you can write a check from the checking account, which will then pull from the HELOC. Or you can swipe a debit card, which will pull from the checking and then sweep from the HELOC. Or you can pay someone with Venmo, and it will pull from the checking and sweep from the HELOC. So you function completely through the checking account, and it accesses that HELOC's, it accesses the HELOC side of things that night, but you have free reign to access the money right away. Where, you know, if you're very intelligent with it, can be a huge asset. If you're irresponsible with it, it can be just as bad as it would be for someone who uses it in a smart way.
Totally.
I mean, and I know I keep harping on that, but I don't want anyone, I don't want anyone to misinterpret what we're saying about this, right?
Right. And the reason I bring that up, though, is because in speed, especially with what we see, having the ability to close on a deal quickly adds to us getting bigger discounts. And while one of the things I know that people have used this product for, is they use that line of credit to fund a deal quickly. They may only have it out, but it gives them the time to close on it. And then their longer term financing, or they're using other people's money that's set up a little bit better to refinance out that HELOC. But they're,
you know what's funny?
Yeah.
You know what's funny? You to me, you're explaining a bridge loan structure where you're your own bridge loan, right?
Yep.
I function as a hard money lender doing bridge loans for people before they get the end loan using my HELOC because they don't have a HELOC.
Right.
Does that make sense? So
totally
like,
makes sense, yeah.
And at the same time, like, guys, you need to get a HELOC because you wouldn't have to pay me this premium to borrow my bank's money, right? And sometimes that works, sometimes it doesn't. But that being said, you're exactly right. You know, so whether you act like a cash buyer, which increases your speed by which you can close, right? It gives you more negotiation power to either talk them down or win the deal. If you have enough equity, now you can be your own hard money lender for the rehab, right? Given that you're good with real estate investments, if this is a flip and not a buy and hold, then you sell and you profit and you put all of what you borrowed plus the profit back into your HELOC, which reduces your balance and then opens back up that line of credit even more than where you had before, right? If it's a buy and hold, right? If you're doing the burst strategy, you could do the same thing. You're your own cash buyer. You do a rehab. You get a renter in there. What is it? Rent. Then
you go get a DSCR loan to refinance
DSCR loan, and
yeah.
you know, you either find someone that can do it within 6 months, or you wait 6 months. You do a cash out refi, and if you've done a really good job with the rehab and the numbers check out, maybe you can get everything back and put that back into your first and HELOC because now 80% of the value of the home, right, is the amount that you have in the home, right? And you know, or if you're better than that, you make more, right? And so now you've got all that money back, right? You didn't borrow, you didn't use your money, you're using the bank's money. And again, it's more personal, right? When I get close to my limit, I feel it, right? But the reality is it's not my money, it's the bank's money. So again, if we're talking about ROI, it's infinite. And all the while it gives you a vehicle to store everything you have in a place that works really, really well for you, that's completely liquid, right? And I think that's the key is once you get into the mindset of the real estate investor, the investor usage of this, it becomes a liquidity tool and a cash flow tool. It's where you drive all your cash flow and it creates liquidity for everything you put in here. And the reason why it's a good place to store it here is because it offsets your interest costs because you create the lowest balance possible. Right? And you pay interest on the lowest balance. And so so that is where I've seen a lot of real estate investors really, really get excited about it. A lot of times the initial go-to is, I need to get this on my investment property. And that's fine, right? That's fine. That being said, it really doesn't matter which one it's on, right?
Right.
I have mine on my personal home because for me, I do see it as a third-party leverage tool. At the same time, it's where I drive all my income, my personal income. It's where what I use to pay for all my family's expenses, right? So I don't have like a third-party system yet, right, to do that. So, you know, because I'm in that stage of development, it's still a personal financial vehicle that I want to keep close to me, right? So if I put that in an investment property, that would feel more what's the word?
Removed.
Yeah, exactly. Right. Thank you. Feel more removed as compared to like, this is my home's financial hub where everything, it serves the purpose for like 5 or 6 different financial vehicles that we're all managing at the same time, creates this one hub. You attack the hub, right?
Mm-hmm.
And it's simple. One of the slides earlier was it simplifies your life. That's how it simplifies your life, is it creates this one financial hub, and you don't consolidate all those other tools here for the reason of it being convenient, right? That's an added bonus. You do that because it's more effective when you consolidate everything here, right?
Mm-hmm.
So you create the most effective tool possible. Well, the most effective tool in this scenario.
If you're smart and
if you're
diligent
smart,
about
right. Thank you.
right? You're like, oh well, that person might not be good for it.
Yeah.
I saw that there.
There's always holes you can pick and stuff. So I want to be careful with saying very, very hard and fast things, because
Right.
But that being said, you create a very, very, very effective financial tool that simplifies your financial mindset and your financial focus, because attacking that one thing gives you a simple place to just crush it. And then that can be motivating because you're not trying to follow 9 different things. You're following the progress of one. And that's the testimonials that I've talked with. That's one thing that is exciting here too. Some people's outcome is much better than the projection that we talked about at the beginning. And I asked them, well, what happened? Why is that? And they said, well, to be honest, I had this budget, but then now I have one representation of my financial success for my household. When that starts to get better and better and better, that helps me to get motivated to get better, to speed that up even more. And so that's been really cool.
Now, I'm sure we got folks out there asking, okay, this sounds great. What are some of the qualifications? What are some of the underwriting terms?
Yeah.
Does this work if I only have 10 grand in equity, or does it work? Do I need to have a specific equity amount to tap into?
Yep.
Let's talk about some of those specifics, Anthony.
Yeah, absolutely. So if we're talking about getting qualified for the loan, that's a different conversation than, is this a good idea for you?
Right.
We have both, right? So we have does this work for you, right? And we run the calculator. What's the projected payoff time? What are you trying to do? Then it's like, hey, I want to get started. We get the application in for the home loan. So this process looks a lot like getting a mortgage, because it is a mortgage.
Yep.
It's not an amortized mortgage, but it's a loan that is secured by your real estate. And by definition, that's a mortgage. It just follows different rules than a regular mortgage does. So the process looks a lot like a mortgage. So, credit score, you're going to want to have above a 700 for the best terms. We can go down to 660, but the terms get really, debt to income and loan to value really get more difficult and just not ideal. So you're going to want to have above a 700. I'll bring up debt to income because that's a factor that people want to hear. I can go to a max 45 debt to income, 45% DTI. The debt to income is the result of your current liabilities minus your mortgage, the projected housing expense, which is the payment that the bank is using for this new loan, right? Over your income. So your liabilities and this projected housing expense can't be higher than 45%. Well, the projected housing expense piece, different banks calculate that differently. So when people say, oh, well, this bank has a 45% DTI, right? I'm like, well, how do they stress their loan? I'm like, well, I don't know. Like, do they stress it over a 30-year amortization or a 15, right? Do they pad the rate? All those things, because there are different factors. So, that's why I kind of bring it up in that way, is that people like to hear 45% DTI, but I don't make debt to income projections until I have everything, right? Because I've been burned enough times. I'm trying to tell people what they want to hear, and I can't do that anymore. So 45% DTI, we can go to 90%, 89.9% loan to value. So if your home is worth 500,000, I can go to
450, basically.
450 pretty much. Yeah, 450 pretty much, yeah. And that's up to 750,000. Between 750 and $1 million line amount, I can go to 80%. And then between $1 million and 1.5, I can go to 70%. We can't have any mortgage lates on primary or rentals within the past year.
Oh, so it's 12 months. Oh, wow. So 2 years. Okay. Nice.
I can only have one within the past 2 years. So if it was, if it was one 23 months ago and that's it, then we can do it. If it was one 11 months ago, I have to wait a month to be able to get it done.
Sure.
Let's see. 4 years from any, major derogatory event like a bankruptcy, foreclosure, that kind of thing. I can do all states except Texas, Hawaii, and Alaska. And for those Texas people, I'm sorry. I'm going to try and work and see if we can get that done. Texas has some funny HELOC laws.
Where they only allow you to pull up to 80% of the equity.
80% of the equity.
Yeah.
Minimum of $4,000 draw. So
Yep.
the velocity banking thing is tough to manage. I'm not sure. I need to look into this. I think that they don't allow for a debit card to be attached to the HELOC, which if that's the case, we actually still get around that because our debit card's attached to the checking, not the HELOC itself.
So they would do that on a second HELOC, but they don't do it on a first. That is an interesting
That is
thing. Yeah. And then, yeah, I don't get me started. As an ex-banker, ex-mortgage broker, I'm like, but that's where it comes down to is that it used to be, I mean, literally like prior to 95, only way to tap into any equity in the house was to sell it.
I was wondering about that because I was like, man, so either someone's nephew got burned by something, or we had a group of people that had some lobbying money and they just wanted to win. And I'm like, man, come on, guys. Like,
that's exactly what it was. The Realtors Association of Realtors wrote most of the lending laws here, and they've set that up favorably. But it changed, back in 95, but still hasn't come the way as everybody else here. But that's okay. I mean, the thing to look at if you're here in Texas and can't do that, you've got some equity and you have equity below 80% of your house, it might be worth checking out.
Maybe, yeah.
Maybe. But here's the thing. You're going to use this as a tool. This is one of the most important things, like you said, is using this as an effective tool to be smart, not silly,
right,
when it comes to it. Now, is there a equity amount that works well for folks that they should have? You said they can pull up to like 80, 90% or 80% or 75, but what kind of that equity amount should they look to tap into?
That's a really good question, because if I think about the available equity that you have, you can define it in a number of different ways. At its core, it's just equity that hasn't been used, right? Available equity that hasn't been used. The most basic definition from a usage standpoint is as your emergency fund, right? So if the reality is, if you cash flow well enough to pay this down quickly, right, 3 or 4 months, and now you've got 10 grand in equity, right? What we're doing is we're taking the risk that within those 3 months, something really bad won't go wrong, right? That in terms of the likelihood of something happening within the next 3 or 4 months, that is that detrimental, it's not very high, right? But there's risk that's added there, right? So we do have people that start fully maxed out, but that is okay because we've already done our due diligence to make sure they're going to be able to pay it down quickly, right? For those people that have savings and you have an emergency fund, if you owe 90% of the value of the house right now, and then you get a 90% first lien HELOC, which means the first lien HELOC is maxed out right now, but you've got savings, you just dump it in here, that reduces the balance to create that cushion.
Yeah,
So if the goal is from a debt reduction standpoint right now, and we want for the available equity to serve as our emergency fund, then either you want to have it right now or make sure that it works fast enough to where you can mitigate the risk and then create one quickly, right? If the purpose is to become a real estate investor or to leverage this right away, then it's how much money do you need? Do you have enough access? Do you have enough equity that would be available to be able to get the deal done that you want, right? And that's a very short-term perspective, right? From real estate investor, the velocity banking strategy, maximize cash flow strategy has to work anyway, which means in a very short period of time, you've paid down your balance, opening up that line of credit to be able to leverage. So from a leverage standpoint, from an investment standpoint, the more equity you have access to, the better, right?
Right.
In terms of the amount that you need to have, as long as the strategy works, you create it. You create access to equity. So, I mean, I can't really put my thumb on a hard number, but I do know that I would rather have access to $400,000 than have access to 50 grand, right?
Right.
So, I mean, if we think about it like that, yeah, from a leverage standpoint, it's better to have more. But even then, even if you're maxed out, the qualifier is not the amount of equity you have in the house. The qualifier is the budget.
Well, that takes you back to if you're going to pull some of that equity, let's say you got 20 grand in credit card debts at 20%, and you use 20 grand of equity now on this line of credit to pay off that debt. But if you keep paying the same amount you were paying, you would build equity over a period of time dramatically, because instead of paying the 20% on the credit cards, you kept that monthly payment at 7% or 8% on your line. You're going to pay that down. That's a basic debt stacking technique would help you pay that down.
Right. And so like that in itself is sort of another add-on, we'll call it, strategy that we teach, is that, you know, if you currently cash flow $2,000, but you have, you know, $1,500 in liability that we can consolidate here, and it's going to be a $30,000 balance, that $30,000 will result in a higher balance with your HELOC, and it'll cost you a little bit more, right? But then you're getting rid of a $1,500 of cash flow of liability payment each month, because the money's not going to these other third parties anymore. Yeah, your first and HELOC costs a little bit more, but that may cost you an additional, you know, $300 compared to saving a monthly cost of $1,500. That's a net cash flow benefit of $1,200.
$1,200, yeah.
That doesn't just move the needle. That can swing the needle. So we've seen a number of times where people cash flow fairly well, or that it's not great, but we consolidate debt here and it works. But then the question we have to ask is, what created all this debt, right? Was that from budget decisions because you wanted the motorcycle that I want to get, right?
You want to go out shopping at Christmas time and buy everybody Louboutins, you know, or something like stupid. Yeah.
So did you rack up all this debt from irresponsible decisions? Because again, it all has to come down to your budget decisions, right? And so I feel like a broken record saying that, you know. I do like it because there really isn't anything else to it, right? To me, it's very, very simple. It's very cut and dry. There's certain things that have to be true. And all the good things that come with this, that we claim, all those things are true. And the budget's there, right?
Let me ask you,
are lies,
right?
When it doesn't work, you know?
Right, exactly. Let me ask you the question here, a few folks. Any chance, since this is a first lien HELOC, can the bank at any time turn off the line of credit like we've seen happen in the past?
Yeah, that's a really good question. A lot of times that question drives from what happened in 8, 9, 10.
Yep.
Right? Second lien HELOCs in the crash were the ones that got frozen, right?
Yep.
The language is in the document. It's there, right? So the language gives the bank the ability to do that. I think the fact that this is a first lien position loan provides some extreme security against the bank doing that, because there's a difference in first and second lien HELOCs, right?
Yep.
So for one, it has to do with what's the first one?
Probably got to do something if the value of the property decreases, obviously.
Value of the property, right? But even if that happens here, right? I think you're safer here. So you think what happened then, right? You had a bunch of homeowners who they had first position mortgages up to 70, 80%, and they had second lien HELOCs on top of their homes up to 95, 100, sometimes even 105%.
Right.
And then what happens is there's this massive decrease in home prices nationwide, which reduces home prices by 30, 40, maybe 50% in some places, right? Which means if you think about the ratio, right, and the equity in the home, for those second lien HELOCs, 100% of the equity that's securing those loans is gone, all of it, right? There's no equity securing. Well, these aren't personal loans. They're home equity loans, and they're dependent on having some home equity to secure them. Well, now all that's gone, which nullifies the loan.
Right.
So now let's think about that with the first lien HELOC. This first lien HELOC is secured by 100% of the value, 100% of the value, all of the homes. So the only way for all the equity that's securing your first lien HELOC to be gone is for the house's value to go to absolute zero. There aren't many things that I say are impossible. That, to me, I'm going to say is impossible. And if that happens, you having access to a first lien HELOC is not the thing you're worried about.
Yeah, we have to worry about a whole lot more.
Yeah, like if that happens, like this is not
right.
like your bank isn't a thing. Like there are no banks, you know?
Right. Is there also any type of conversion clause? If somebody pays down for a while and they want to convert it, do away with the first lien HELOC and convert it to a traditional 30-year or 15-year, anything like that?
So it's the way it functions, it actually functions like that.
Okay.
So in terms of there being a clause, no. But if you wanted to get out of it, it would just look like a refinance. Because again, this is a mortgage, right? So there's a transfer of title. We do full underwriting, you know, there's it's recorded with the state as a mortgage. So to get out of any mortgage, generally speaking, if we're going to think of it like that, you do a refinance. But the way it works is it's a 10-year draw. So it functions as a HELOC for 10 years. And then at that 10-year part, it converts into a principal and interest payment that's amortized over 20 years to facilitate the pay down. Now, most people don't want to get rid of it. So they just refinance sometime before that 10-year mark into another first lien HELOC to extend it for another 10-year draw. Okay. So like even if people's homes are completely paid to zero, reality is having access to all that equity is much more valuable than not. So they'll just pay for some closing costs and then get it done. So
well, but that's the worst case is an emergency fund, and that's the biggest thing I see from like people that come over into the investing space that come full time is they're going from having a salary steady income to it probably being fluctuating a little bit, and they've got all this equity in the house. Well, once they become a full-time investor, you're going to have 2 years of seasoning as that to get any type of loan. And there's a lot of things you can do that normal banks are like, no, we're not going to lend to you now since you don't have this work history and your credit may not be as good or stuff like that. Of tapping into it, making sure that your lines of credit are set up before you ever decide to jump ship and become a full-time investor.
Right.
You know, that you're staying.
So
work history works in your favor versus it jumping.
We do the same thing. So if anyone's watching and you're thinking about leaving your W-2 and becoming a real estate investor, and this is the direction you want to go, do it before you go full-time real estate investment. Because we are going to follow very, very similar guidelines as to what Fannie and Freddie do. And so we have the overlays or particular guidelines for a specific product. We do have some overlays for our particular bank in this product, but generally speaking, we fall back on Fannie and Fannie Mae's guidelines, which are going to be similar to what you'll find with conventional and FHA, VA kind of stuff. So
we've talked about this. We'll probably ask a question about points, cost of the loan to originate. Is there any points, or is it extra yield spread, premium, or any of that stuff?
So it's pretty simple. There are two rate options. When we talk about points, we talk about buying down the rate, right? I have two rate options, and neither one costs more than the other. It's pretty easy to hard quote. Right now, December 3rd. Well, no, hold on. Right now, at this point in time, I can say that our rate is, we have a 5-year fixed at 7.75%. And then it converts to a variable rate product for the remaining 5. The rate's calculated for that product. The variable rate is calculated for that product by looking at the 6-month treasury bill and adding a margin of 4.5 each month. So each month it looks at the 6-month T-bill, adds 4.5 margin, right? That's one option. The second option is you can go straight into variable right away for the full 10. That looks at the 6-month treasury bill each month, but that adds a margin of 3.25. So you would choose that one. You'd choose the variable rate product if you think rates are going to come down sooner than later. and you would choose that variable rate product for the difference in the margin for the last 5 years between the two, right?
Cool.
For people that rely on having a consistent rate, so they know exactly what the payment's going to be, that's something that they can count on, then the fixed rate option would probably be the better one. If that's your priority. Our most popular one right now is the variable rate product. Right now it's sitting at about 8.5%. So if rates do come down, 6-month T-bill would only need to come down 0.75 of a point to be equal with the 5-year fixed.
Right.
So, the 5 and 10-year average for the 6-month T-bill plus 3.25 plus the smaller margin is in like the 5.5 range. So if we use historical averages to find where we think that sweet spot would be, it would suggest that 6-month T-bill plus 3.25 is going to lie a lot lower than the fixed rate option. So, but in terms of cost, so that's the rate options, but they're the same, right? So there's no additional cost. So cost wise, the bank fee. So with any refinance or purchase too, right? Generally speaking, closing costs, I like to think about that you're just paying, people have to do work to get the transaction done. You pay people to do work, right? So we've got the bank does work, you've got the appraiser does work, you've got title company, and then you've got what you accord with the state. And whether they do work or not is up in the air, but their fee. So the bank fee is a flat $14.95. I can hard quote that, right? That's it, no difference. So a lot of times, this is where your fluctuations in these costs will come, generally speaking, from company to company, because sometimes there's an origination fee of 1% of the loan amount, and then they tack on origination, or then they tack on like processing and underwriting fees. Those little junk fees. We have one junk fee, and it's $14.95. That's it. The appraisal is usually $500 or $600, depending on kind of where
where it's at.
Title and state fees are hard for me to hard quote. Because I'm sure you've analyzed this enough.
Well, some states like California have both title and escrow fees are different. Other times they're one. I mean, that's going to vary state by state a little bit.
So this loan doesn't escrow, so there's not going to be escrow, but we pretty much do nationwide except for those 3 states. Title insurance is your big title cost that fluctuates based on the loan amount and your location, right? And then every state has a recording fee. Some states also have a transfer tax.
Right.
So Utah doesn't have a transfer tax. Like Tennessee's is like $800. Like Florida's is like $3,000. If you live in New York State, it's like 12 to 14,000. I don't have a running list of those. And so I can't hard quote title or state, but I do know that your title and state fees for this refinance, for first lien HELOC refinance, wouldn't be different than a conventional refinance title and state fees for the same property, right? So that would be the same, same title company, same property, same transaction, just different HELOC type. Those would be consistent. So it's not like a HELOC refinance comes with higher title fees or higher state fees.
Right, exactly. Now, what's for folks if they're interested in connecting with you or finding out what they can qualify for to have a conversation with? What's the best way for them to reach out to you?
Yeah, I really appreciate that. So you can go to firstlienheloc.com. It's a free educational resource where you can dig into this even more. And we're actually about to launch version 3 of this, which I'm excited about. But yeah, so firstlienheloc.com is a free educational resource for people to learn more about this. There's a calculator that you can click on and you can run your numbers, which will give you a good idea initially. The thing that I find with that is sometimes people put in the wrong numbers and they get the wrong output, right?
Right.
But this is a good place to start to read about what this is a little bit more. You can try the savings calculator. And then if you look in the top right-hand corner, it says sign up. You're signing up for a discovery call with one of the people on my team, right? So it's not like you're signing up your life, or I think we need to say schedule discovery call button instead of sign up, because people are like, well, what am I signing up for?
Right.
Well, you're signing up to talk with one of our specialists who again will run you through what it is, how it works. We'll run the calculator with you, make sure that lines up, talk about your goals, make sure that this works for what you're trying to do. And if it does, they can help you get into the loan as well.
Awesome. Good stuff. Yeah, the website's firstlienheloc.com. Click on the upper right-hand corner, sign up, or probably in the near future, it'll say book a call.
Yes.
With folks out there.
Book a discovery call. Yeah.
Yeah. And this phone number up here at the top, that will also take them to somebody in your office too,
Yes,
Anthony.
it will.
Because it's here's the thing. I think remember when we talked originally, it's your team. You've got a team of like 7 or 8 people that are handling this all across the country. Is that correct?
So yeah, I want to say we have right now it's 11 or 12. Okay. I've got 4 loan officers, and then we've got loan officer assistants and processors. This is all that we do. And so we have access to the other mortgage products, but this is, I mean, I would say on any given month, I might have had one conventional.
Sure.
Right now we can't only do primary residence properties. I think it's important to say that too.
That's true. Yep.
We're looking into opening it up for investment properties. But again, if you're an investor, it really doesn't, it works either way, if that makes sense. And so yeah, check out the website, either call the number up there or click the sign up button, and schedule a call with one of us if you think that this might be a good fit for you. Having done testimonials recently, I'm really excited about it because I have proof. I have people that are sharing amazing stories about how this is changing their life, and the way that they control it is helping them direct their financial lives in a way that they want, or help them enhance what they're doing already to try and achieve what they're trying to achieve. Mm-hmm. So, again, like we talked about before, any product, there are multiple options that we all have to choose from. Being aware of the multiple options that are available and the factors that they bring and who they work for, that to me is what we're trying to help people with here is, hey, look, here's what this is and how it works. The reality is it's a thing. It's a real type of home loan. I mean, like that's true. And so if you want to learn more, check out the website. If you want to talk to one of my team members here to see if it could be a good fit for you, go ahead and click the sign up button or call into using that number, and we'll be more than happy to help you with
awesome. Good stuff there. Yeah, guys, I have to tell you, if you use something like this, use it as a tool. If you're not going to use it as a tool, this is not for you. But for those of you out there that are smart, intelligent, and can follow a pretty easy game plan for you, can definitely pay your house off in 5 to 7 years and use this to tap into the equity so you can use it for other things, emergencies, or use it as an investment tool to have that cash to be able to close the deal quickly and go from there. But check it out, firstlienheloc.com. Anthony, thanks so much for joining us on here and sharing your knowledge, sharing your stories, and we look forward to those folks out there you're going to be helping out here before too long.
I'm excited. Thank you so much.
Thank you.